In this video, I'm going to complete exercise 1-13, and you can print this handout. It's available in Bring to Session, Chapter 1. So you need to work the problem with me. Here we go. Okay. We've got several transactions that we're going to put into the accounting equation, right? And so this is what it kind of looks like. Let's read the first one. The owner invested $60,000 cash in the company along with equipment that had a $15,000 market value in exchange for its common stock. Okay, so the cash was received, right? Would cash go up or down? Well, if you received it, cash goes up. But we also received some equipment. So if we receive the equipment, we know that equipment goes up. Now, who gave the cash and the equipment? Well, the owner did. So we're going to give the owner the claim to these assets through common stock. Let's see how it works here. So we receive $60,000 in cash. So cash goes up $60,000. We also received $15,000 in equipment. So put $15,000. Now, who has claims to those assets? Well, the owner does, right? So he gets $75,000 in his common stock because he has claims to those assets. He's the one that put them in. Okay. So now let's go ahead and do B as in boy. The company paid $1,500 in cash. We'll stop right there. You paid cash. Does cash go up or down? Well, if you pay it, it goes down. And then why did you pay the cash? Because you're paying rent for office space. So let's see how that works. In B, we paid $1,500 in cash. So we subtract $1,500 from the cash. And why did we pay the cash? We're paying for office space. It's rent. So that's an expense. Now, what's interesting about this is that you need to put in a positive amount, $1,500. And you say, Tetra, that doesn't make sense because we're supposed to balance, right? Matter of fact, here's our seesaw, right? Whatever you do on this side of the equal sign, you have to have this on the other side. So here we're going minus 1,500, and here we're going plus 1,500. No, because you see this minus sign, that means that this positive 1,500 is really a minus 1,500. This is how Connect is going to do it. So you just got to remember that a positive 1,500 here under expenses will actually be minus seen from the equity because of this little minus sign here. Okay, now that we have our transaction, let's bring down the balance. 60,000 minus 1,500 equals 58,500. Okay, bring down the equipment, 15,000. Bring down the 75,000 to 75,000. Bring down the 1,500, 1,500. So we're always going to balance the accounting equation. Okay, let's do C. The company purchased $10,000 of additional equipment on credit. When you say on credit, that means you're going to pay it later, right? You're going to pay it later. So if you bought the equipment and you're going to pay it later, well, you owe it, don't you? So this is going to affect our accounts payable. Let's look at C. We have equipment of 10,000, right? Because 10,000 came in. But we didn't pay cash for it, right? Instead, we told the guy, I'll pay you later. It's on credit. So what happens? Our liability goes up, specifically accounts payable. Now notice here that on this side, our assets go up 10,000 on this side of the equation, and our liabilities go up 10,000 on the other side. So we are in balance. The equation always has to be in balance. So what's our new ending balance here? Well, bringing the 58,500 down. And then under equipment, 15,000 plus 10,000 is 25,000. Bring the 10,000 down. Bring the 75,000 down. Bring the 1,500 down. So if you netted this out, you could see that we are in balance. Let's go ahead and do D as in dog. The company completed work for a client and immediately collected the 2,500 cash earned. Well, we earned it something, right? Because we completed the work. So if we earn something, we know that's going to affect revenue. So you know revenue is going to be increased because we earned it. Now, in this case, we did collect the cash, right? And if we receive the cash, cash goes up. So let's see what it looks like for D. We received the cash of 2,500. So we increased cash 2,500 here. Why did we receive the cash? Because we earned revenue. So that's going to go over here under revenues, $2,500. Okay. So we're in balance, right? The assets went up 2,500. Equity went up 2,500 through revenue. Okay, we can bring down our balance again. 61,000, 25,000, 10,000, 75,000, 2,500, and 1,500. Okay, let's go ahead and do E. E. The company completed work for a client. Oh, completed work, that must be revenue, right? And sent a bill for 8,000 to be received within 30 days. Well, this time we completed the work, so we know that we're going to earn revenue of 8,000, but we didn't receive the cash. Why? You sent a bill for it, and the guy said, I'll pay you later. Well, you own the right to receive that money, correct? So if he owes you, it's going to increase your accounts receivable. Let's see how that works in E. Okay, so we earned 8,000. So we'll put 8,000 under revenue. And did we receive the cash? No, we didn't. But the guy told us he'll pay us later. So it goes under our accounts receivable. Okay, is that interesting? So it does balance. Our assets go up 8,000. And specifically, the asset accounts receivable goes up. And on this side of the equation, equity goes up because we increased revenues by 8,000. Let's go ahead and bring down our balance. 61,000, 8,000, 25,000, 10,000, 75,000, 10,500, 1,500. Okay, let's do F. The company purchased additional equipment for 6,000 cash. Well, you paid cash, right? So does cash go up or down? Well, if you paid cash, cash is going to go down by 6,000. And why did you pay the cash? You're buying additional equipment. So the asset equipment is going to go up. Let's take a look at this, F. Okay, so we received equipment of $6,000. And this time we went ahead and paid cash for it. So it's going to be a minus 6,000 under the cash. Notice that we're trading one asset for another. We're giving up our cash of 6,000, but we're receiving the asset equipment for 6,000. Just trading one asset for another. Let's bring down our balance. 55,000, 8,000, 31,000, 10,000, 75,000, 10,500, 1,500. All right, let's do G. The company paid an assistant 3,000 cash as wages for the month. Well, first off, you paid cash. Does cash go up or down? Well, cash is going to go down. Now, why did we pay the cash? We're paying our employee for wages. So that's wages expense. Okay, let's see what that looks like in G. Okay, so we paid cash of 3,000. So we're going to subtract 3,000 from cash. And why did we pay the cash? To pay our wages, to pay our employee. That's going to be wages expense. So we're going to go over here to expense. Now, remember that we're going to put expense as a positive number. Why? Remember, this is a minus sign up here. So when you put positive 3,000 here, it really is a minus 3,000. So a minus 3,000 in assets, a minus 3,000 in equity. We're good. We're in balance. Let's bring down the balances here. 52,000, 8,000, 31,000, 10,000, 75,000, 10,500, 4,500. Okay. Let's do H. The company collected 5,000 cash. We'll stop right there. Cash is going up, right? So we're going to make a positive 5,000 to cash. Now, why did we receive the cash? It's for a partial payment for the amount owed by the client in transaction E. C and E, we completed work and we sent a bill for 8,000. And the guy says, I'll pay you later. So we increased his accounts receivable. But now he's paying what he owes us. So while we increase our cash of 5,000, we're going to reduce his accounts receivable because the guy doesn't owe us anymore. He paid it, at least 5,000 of it. Let's see how it looks. H. Okay, so we received 5,000 in cash. Why? Because our customer is paying what he owes us. So he paid us, so he doesn't owe it anymore. So we're going to reduce his accounts receivable by 5,000. It's interesting to note that he did owe us 8,000 and he paid us 5,000 so we can reduce his accounts receivable, but notice that he still owes us 3,000. Let's go ahead and bring down the balance. 57,000, 3,000, 31,000, 10,000, 75,000, 10,500, 4,500. Okay. Let's do the very last one. I. No, we got another J. I'm sorry, we got one more after that. The company paid 10,000 cash. Oh, you paid cash. Does cash go up or down? Well, if you pay it, cash is going down. Why did you pay the cash? To settle the liability created in transaction C. See, we purchased $10,000 of equipment and we told the guy, I'll pay you later, right? So we owe $10,000, but now we're going to pay it. And when we pay it, we're not going to owe it anymore. So we're going to reduce our accounts payable, reduce our liability. Let's see how that looks. I'll make this smaller, I think. So yeah. Here we go. Okay, so we paid cash of 10,000, right? So minus 10,000 in cash. And because we paid the cash, we don't owe it anymore. So we're going to reduce our accounts payable by 10,000. Notice here that before we paid it, we owed 10,000. But now that we paid the 10,000, we don't owe anything anymore. We don't owe anybody here anymore. Let's bring down the balance. 47,000, 3,000, 31,000, 0. We don't owe any accounts payable now. Under common stock, 75,000, revenue 10,500, and expense 4,500. Okay, now we'll do the last one, J. The company paid $1,000 cash. Well, right now, if you pay cash, does cash go up or down? Well, if you paid it, it's going down. So we know the cash is going down. Why did we pay the cash? Because we are issuing dividends, which are distributions of our profits. Okay, so it's going to affect the dividends account. Here we go. Let's go down here to J. So we're going to reduce cash by 1,000, right? Cash is going down 1,000. And then we're going to put that 1,000 into dividends. Now, again, it's a positive number. And face value, it just looks strange because you got a minus 1,000 here and a plus 1,000 over here. But remember, do you see this minus sign? So when you put a positive number here, you are going to subtract it. Okay. So what do we have as far as the end? The ending balances would be 46,000, 3,000, 31,000, 0, 75,000, 1,000, 10,500, and 4,500. Now, if you wanted to make sure this works, I can tell you here that if you add these three up, it's 80,000. 46,000 plus 3,000 plus 31,000 equals $80,000. Okay. Now, on this side, it should equal 80,000 as well. How does this work? Well, 0 plus 75,000 for common stock. Now, this is interesting. This dividends is a minus, right? Because that minus sign. So minus 1,000. And then revenues would be plus 10,500. And these expenses, because of that minus, you're going to minus 4,500. So again, it's going to be plus 75,000 minus 1,000 plus 10,500 minus 4,500. You net that together and you'll see that that's 80,000. So there'll be 80,000 on this side and 80,000 on that side. Okay. That should do it. We'll see you next video. Bye.